Good morning, everyone, and welcome to our Gilmore, Jason, Mahler webinar this morning on the Paycheck Protection Program Flexibility Act. I'm Susan Ross Wells. I'm the marketing manager for GJM, and I'm joined by Bob Bobek, who's going to be presenting this morning. Bob has been presenting pretty regularly on the PPP program and all of these unfolding developments and changes in guidelines and restrictions, et cetera, for all these businesses. But the great news is today is going to be talking about some easing restrictions, and hopefully you all are in a better place now than you were a few weeks ago prior to the PPP Flexibility Act. So Bob is an assurance partner with GJM and has over 35 years of public accounting experience. Works with a lot of different companies in all sorts of industries, but certainly his main focus is in construction and manufacturing. Couple other quick sort of housekeeping items to mention. We do have a Q&A area on your GoToWebinar screen there. So please feel free to post any questions that you have. We're going to be monitoring those questions throughout the webinar. And also there's a chat area. Feel free to use that as well. And our partner, Greg Taylor, is going to be moderating our Q&A session once Bob is finished. Also, we've got a handout for you of Bob's slides if you'd like to download those during the course of the webinar. And I think that's it in terms of housekeeping. Also, a quick thank you to Courtney Haas, our marketing coordinator, for sort of being our organizer this morning. So we appreciate all of her hard work. So with that, Bob, I think I'll hand it over to you.
Thank you, Susan. Thank you. And good morning, everyone. You know, this has been quite a changing road we've been on ever since this CARES Act was passed on March 27th. And it was a brand new program, as we mentioned over and over again, and its single purpose was to provide liquidity into our economy. And just to give you a little history, I'd always like to look back at what happened and where we're going. But, you know, this program started about 2 months ago, a little over 2 months ago, and the first loan was made on April 3rd. And in the first round, $348 billion was used up, and the program was shut down on April 16th. And so it really was very well received, and a lot of people or companies participated. Now, again, as we mentioned, it was to provide liquidity to the economy. And so we're going to look a little bit more at that throughout this presentation. But, you know, it appears to be working at some level because unemployment rates were expected to go up in May, and they went down in May. And so that is some of it has to be attributed to the PPP program and employers like yourself retaining employees or calling back employees to take advantage of the forgiveness that's part of the PPP program. So then on April 24th, Congress refunded the program and put another $310 billion into the program to fund future loans. And they also funded, I just want to talk about a little bit of the $50 billion into economic injury disaster loans. So again, those are available again during the first round of the CARES Act. All the money also was used up on the economic injury disaster loans. So then on April 24th, they refunded or funded a new program for $50 billion, and that money is still available. I don't know how long that money will last, but there is a possibility of still get access to that program. So here, what we're talking about today is a new law, the Paycheck Protection Program Flexibility Act. It was signed on Friday, June 5th by the president. This has overwhelmingly support by both the House and the Senate. The House vote was 417-1, and the Senate was unanimous consent of the law. Now, this is a correction act. So what it's doing is a 2-page law that modifies certain provisions of the existing CARES Act. So either expands or replaces certain provisions. And so throughout this presentation, we have made those new sections green. So when you see green, that is the new provisions provided by this Flexibility Act. And this June 5th date becomes very important. So that's why we'll be circling back or referring back to the June 5th date throughout this presentation. So again, real quick, What is the Paycheck Protection Program? It is a forgivable loan program administered through the Small Business Administration 7-8 program. You apply through your financial institutions, and they have 10 days to fund it once you've been approved by SBA. The first allocation of $348 billion was used up on April 16th. The second allocation of $310 billion, the loans first started being made under that tranche on April 27th. And actually, as of May 16th, I checked actually as of June 6th, there is $131 billion still available. So this, there's still money for those entities that have yet to apply. Unfortunately, you only get to apply for one loan. So if you already applied and got funded, you cannot apply for a second loan. So here is the statistics we get every time from SBA right off their website. This is through Saturday, June 6th. And the total amount approved right now is $511 billion. This actually has dropped. I think 2 weeks ago, this was as high as $513 billion. So some loans, it looks like more loans were paid back, and we'll talk about maybe why later on in this presentation, than new loans were made. So there's still plenty of funds available for those entities that have yet to seek a loan. And just some information about lenders, some more information about some lenders. What I want to get to is this. This is the allocation by states. Ohio remains the 7th largest participant in this program. And they have been allocated $18 billion in loans. And from this slide, as you can see, we're going to talk about this. The most significant items here are the loans over $2 million, and we'll talk later on why. And that's about 21% of the amount and less than 1% of the number of loans. And the average size of the loan now is $113K. That is actually slightly down from last time they reported, which I believe was $116K. So what appears to be happening, there's a lot of smaller, maybe companies and organizations now applying that did not apply in the first round, and the overall average is dropping a little bit. And this is now a listing of lenders. In the past presentations, they just had a number. Now they've actually disclosed the name of the banks. And it's no surprise to anyone, but the large banks throughout the country lead the list on the number of loans and dollar amount of loans, with JP Morgan the largest, and Bank of America about $4 billion behind. And then it starts dropping off with PNC, Trust Bank, Wells Fargo, and all the other significant large banks are on here. But there were thousands of banks that participated in this program. I believe it was like 4,000 or 5,000 different financial institutions. And this slide here shows, they got this slide back in this presentation. It shows use of the funds by industry code. And as you can see, healthcare is the largest user of the program with nearly 13%. Then becomes professional, scientific, and technical services, which another 12.7, and construction is slightly behind at 12.4, and then manufacturing is 10.46. As you can see, it starts dropping thereafter. So again, as part of this slide, they have now put in a slide that says, here's the amount of money that's available. And so it's 130,681,000,000. So again, back to the basics of the PPP loan program, how it works, how you ask for your loans, draw down your loans, and how it changes, how the new Flexibility Act changed the law. So as you can see in in green, I've inserted the new changes. So again, the maximum loan is $10 million, calculated based upon a formula of 2.5 times average payroll. The original law had the loans could have a maturity up to 10 years. SBA guidance early on changed that to 2 years. The Flexibility Act now changes that to 5 years. However, the SBA director came out with a ruling yesterday And that will be only for loans that originated after June 5th. So if you got your loan prior to June 5th, you're still required to have a 2-year maturity on any amount that's not forgiven. I don't know if this is going to be significant for most clients because the SBA and most of their guidance that they're providing are saying that we're trying to maximize forgiveness. And so I don't foresee a lot of institutions, companies, organizations having a significant loan at the end of the forgiveness period. Again, the use of the loans are for payroll costs, health insurance, all the related costs to payroll, mortgage payments, rent, utilities, and interest on other debt obligations. You know, you're not required to segregate these PPP loans in a separate bank account. You can commingle it with your operating account. However, you will have to track how you spend this money, and we'll talk about that later on. Again, there is this process to request forgiveness. There's an application. We expect that to be revised, and this process will start. Companies can start applying for this process soon. For those clients or companies that drew their money down on April 3rd, they are probably hitting the point now of the 8-week if they still want to use the 8-week period. Again, we're going to talk about this economic uncertainty certification. We've had some questions recently. Has that changed under this new law? The answer to that is no. The only guidance out there is what's previously been out there. The one change that did come out of this law, this program for new loans officially shuts down on June 30th. So there will be no additional funding past June 30th for any new loans. Okay, so let's talk about the uncertainty certification because I think that's very important for companies to understand, and it's still a possibility that the SBA might ask for your support in this question. And again, you know, when you apply for the loan, you had to check a box that pretty much says that there was uncertainty to the company due to the pandemic, created a necessity of loan. And so the actual certification is right there. Current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. So the SBA ruled through their guidance that loans under $2 million will automatically be deemed as meeting this requirement. For loans greater than $2 million, the SBA could come in and ask to see your reasons why you meet this requirement. Again, early on it was called an audit. I don't think anyone's referring it to an audit anymore. It's more of an inquiry. Again, you've got to remember the SBA is a government agency that's basically runs like a financial institution, like a bank. Their main purpose is to make loans and approve loans. And so it's more or less about making inquiries about applications. SBA has been doing this for many years and other programs. And so they're used to asking these types of questions. There was a Q&A, and that's where some of the original guidance comes from. As of Monday, I did not see any new items in this Q&A, and I think I checked yesterday. There was no new items in the Q&A. But this existing answers in the Q&A exist, and this is where they talk about this uncertainty. This originated when it was determined that public companies had access to the market. And so they issued some guidance that, you know, if you got over $2 million, you know, that you need to prepare to demonstrate that you had no other sources of liquidity. And it referenced public companies with substantial market value and access to capital markets. It was not really asked, it was not requiring if you have an open line of credit. And so there was a later question that spoke to the availability of an open line of credit. And instead of answering that question, the SBA just referred back to this existing answer. So it was primarily targeting public companies, and those are primarily, I believe, most of the companies that paid back the loans. Later on, they came out with some more guidance that says, if you don't meet this requirement, you know, the penalties or the requirement will be simply that you have to pay back the loan over the life of the loan. So if it's prior to June 5th, you would have a 2-year repayment period, and after June 5th, you'd have a 5-year at 1% interest. And again, the PPP loan program in the CARES Act waives the SBA rules requiring you not to have access to other borrowing facilities such as a line of credit. So we're recommending all companies, even small companies that have less than a $2 million loan, still take the time right now to document the uncertainty they were facing when they asked for the loan request. And again, a lot of the ideas are you do a forecast of loss operations, a projection that shows potentially if you're losing money and you're using cash to fund those losses, the cash depletion. I mean, for most companies, everyone we're talking to, the payment, the collection of their cash, their account receivables are slowing greatly. And so that should be documented. Also, reduction in future sales activity. I talked to a lot of manufacturers and their sales plummeted, especially in the auto industry in May. I mean, I've heard horror stories of some companies that had a 95% reduction in sales. And I hear from other contractors that, well, they got some work right now, the bid opportunities are drying up down the road. So, document all that. Supply chain and subcontractor disruption. We continue to hear about this. I mean, auto industry, there's all kinds of disruption in supply chain. And for a lot of manufacturers, there are, especially for international supply chains, where those countries might be shut down. And then in the subcontractor world, for contractors, it's some subcontractors, if you're building a building, maybe the electrical contractor is available to come to a job site, but the contractor that you awarded the work to do the foundation is not available to come. And so that's causing a lot of disruption to the construction of the building. Obsolescence and perishable inventory losses. As inventory ages and sits in your warehouse, there's a potential that it becomes you can no longer sell it. Or it grows because customers are not ordering anymore, and you have excess inventory. And the one that we keep seeing over and over again is work stoppage or cancellation by the customer or local government. A lot of local governments shut down the states, and so you could not work in those states. Those businesses had to shut down. I know Ohio's trying to come back. I believe we'll be all back. All sectors of the economy in Ohio should be back, I believe, by next week. I heard Cedar Point's opening up and the amusement parks are starting to open up and stuff like that. That was the last stage. I know Michigan still has a significant shutdown, but I know they're starting to open up also. So the forgiveness period. So here's one of the big changes. Okay, you now have 24 weeks if you like. So you have to choose between using an 8-week or a 24-week forgiveness period. Everything else pretty much stays the same. You got the payroll costs and non-payroll costs. The loan origination is the day the company receives, and so that's the beginning of your covered period, whether that be an 8-week or 24-week. For those borrowers that got a loan prior to the new act, June 5th, 2020, and that's that date, you can retain an 8-week cover period. You do not have to use a 24-week. For loans made after the June 5th, they must use a 24-week. And so we're recommending that you recalculate it both ways. Right now, if you're getting close to your 8-week, and see how well your forgiveness is being calculated, and then determine whether or not you want to elect a 24-week. I think the downside to the 8-week is it's of course a truncated period, and there maybe is less cost and more exposure to something being challenged. And then also the FTEs. So under a 24-week period, you're going to have to follow the same FTE test that we're going to talk about for 24 weeks versus 8 weeks. And so especially in the construction industry, they normally shut down around Thanksgiving. And so they start laying off people in November, December, just because of the winter's coming. And so you don't want to be trapped with a 24-week period and then fail the FTEs because you're laying off people at the end of that 24-week period. So again, it's just important to look at both and make a decision which route you should follow. Again, the original loan forgiveness application was released on May 15th. It is still built around the original 2 laws. It does not have the reflection of the PPP FA law. but we expect, everyone keeps on expecting a revised application will be coming out shortly. That is the link below to the website that has the existing application and will have the new application once released. So again, cost eligible forgiveness. There's this concept of paid or incurred, and it's during either a 24-week cover period, which is 168 days, or you can elect to do the original 8-week cover period. Again, under the 8-week, it's probably more important. Prepayment expenses usually not allowed. There was guidance issued around this area on May 22nd, 2020. In this guidance, they did clearly say that you could pay for furloughed employees bonuses or hazard pay during the cover period will be eligible for loan forgiveness. So I know there's a lot of questions early on, can I do a bonus? And the answer is yes. Here's the little potential issue that needs to be dealt with versus the final law that was just passed as compared to the guidance. So when the guidance was issued, they had put a cap on owners' compensation. This would be self-employed individuals, members of limited liability companies, or owners of companies that get a W-2. It was basically capped at 8/52 of the owner's 2019 wages, or $15,385. So if the wages were down in 19 or their earnings were down in 19, below 100,000, it was capped at a lower dollar amount, lower than a 15,385. This is provided for in guidance, not in the law. This guidance has not been updated to reflect the changes in the new Flexibility Act. So currently, this guidance still exists and calculate even on a 24-week period for the owners of companies. They're limited currently to $15,385 or the lower of their 2019 wages at 8/52. So again, this cap is still there. We expect this to be changed, but currently it's still there. For companies that have more, a significant number of employees, this probably has little impact. But for the smaller companies where the owner is maybe 1 of 4 or 5 employees, this could have a significant impact. So payroll cost, same definition used to draw down a loan. So under the new law, you only have to spend up to 60% of the cover loan for payroll costs. The previous law had a 75, not the law, but the guidance had a 75%. But the law now says 60% of the cover loan. And so there was this big talk about a cliff. So the cliff was the idea was that if you had $1 million loan, you must spend 60% of the $1 million loan on payroll costs. So that would be $600,000. And let's say over the 24-week period, you only spent $500,000 because you just were slow to get back to work. There was a big debate out there that there was a cliff, that if you didn't meet that 60% of the cover loan for at least on payroll costs, you lose all your forgiveness for the entire loan. The SBA director released a statement yesterday that says, no, that's not the case. There is no cliff. So if you only have 500,000, those 500,000 wages do qualify for forgiveness. So they've answered the question on the cliff. Again, salary and commissions up to 100,000. Again, we're limiting the the owner's compensation at 15,385. If you elect the 24-week period, for everyone else, you now get 46,154 in payroll for the 24 weeks. And if you remain with the 8-week, it stays at the 15,385. That's for employees, not owners. Then you also add group health insurance, that still stays. Retirement benefits still are included. State and local taxes, unemployed comp. And there is this alternate payroll cover period that probably comes into play. If you're doing the 8-week cover period, it probably is not that important anymore with a 24-week cover period. And again, this alternate payroll cover period was aligned with the borrower's payroll. Started with the first payroll of the first day of the company's first pay period following the PPP loan disbursement date. and you can choose that period. So in this example, you got your loan on April 20th. Your first payroll was April 26th. You could either begin your 8 weeks on April 20th or April 26th and follow 8 weeks after that date. So if you selected April 26th, your forgiveness period ended on June 20th. And if you selected April 20th, your forgiveness period ended 1 week earlier on June 13th. If you use this alternate pay period, you must use that for calculating all related payroll costs in the forgiveness application. So here's an example again. Again, it's 8 or 24 weeks. For 24 weeks, the maximum wages for non-owners is $46,154. And for 8 weeks, it's $15,385. That's for both owners and all employees. And then you got group health insurance, retirement benefit costs, state and local taxes, and those earnings for self-employment, that'd be Schedule C or members of LLCs. So here's the other significant change in the Act. You now can spend up to 40% of the amount to be forgiven on other costs other than payroll cost. This used to be at 25% from guidance provided by the SBA. Those buckets remain the same though, they have not changed. So the three areas are rent, utilities, and mortgage interest. And again, there's this concept of paid or incurred during the covered period that still exists in the guidance. So what does that mean, paid or incurred? That means paid or incurred prior to the next billing cycle, prior to the end of your forgiveness period. So an example, right in the guidance, your covered period begins on June 1st and ends on July 26th. During that period, you pay both the May electric bill and June electric bill, so both those qualify. And then on August 10th, after the end of your forgiveness period, you pay the July bill. You're allowed to pick up the May bill, the June bill, and the portion of the July bill that relates to utility spend from July 1 through July 26. So you're basically picking up almost 3 months of utility bills by using this incurred or paid concept. And this is right in the guidance as verbatim from the May 22nd guidance. And so what's rent again? Rent is any rent obligations under existing rental or leasing agreement that was enforced prior to February 15th. Again, this is not just rental of buildings or real estate. This is also personal property. This would be trucks, copiers, the other equipment you might be renting. This does not have to be a long-term leasing arrangement. It could be a short-term rental arrangement, just as long as it was entered into prior to February 15, 2020. So if you're a contractor and you have some rented equipment at your job site and you entered into that prior to February 15th and you continue to use that equipment during your covered period, those costs would qualify. Utilities, again, all the standard electricity, gas, water, telephone. This includes cell phones, internet access. And again, we're back to this transportation, no new guidance on this. The only guidance out there right now on this transportation line item is the SBA guidance that was released to self-employed individuals, those that have Schedule Cs. And under that guidance, they reference that, for example, fuel used to put into your trucks that you use in your business would qualify as a forgivable utility cost under transportation. So fuel costs should qualify as long as it's paid directly by the company and billed to the company. So I've had some manufacturing clients, they're buying propane to be used in their tow motors, forklifts, that should qualify. And so back to leases, if you're leasing your forklifts, that would qualify, or renting them, as long as the agreement was in place prior to February 15th. And the last bucket that you can use in the non-payroll cost is interest on a mortgage. So the loan has to be in the name of the PPP borrower. There needs to be a collateral either directly on real estate or personal property. So this would be truck loans. And again, this was referenced in the Schedule C guidance put out there by the SBA. So truck loans, equipment loans, as long as that's collateral on that loan. Again, the debt had to be in existence prior to February 15, 2020. And you cannot include any advance payments of interest on this loan eligible forgiveness. You know, there is some guidance out there suggesting that if you have a loan from an officer or an owner that's collateralized, it has to be collateralized. It has to have a direct collateralization agreement on real estate or personal property that was in existence prior to February 15th would qualify. So you just got to make sure that you've done all the filings for the collateral prior to February 15th, and it would qualify also. So here's the cost. The cost paid or incurred during an 8-week or 20-week cover period, depending on which period you follow. And so you got rent, utilities, and interest on real estate or personal property loans. And it's now limited to the lower of your actual costs or 40% of total forgiveness. So in this example, the 40% total forgiveness is $350,000. Their actual non-payroll cost is $175,000. So in this example, they would get to include $175,000 in non-payroll costs. So the last part of the test is the FTE test. So this is where you then have to calculate your FTEs for a period prior to, there's 2 different look back periods prior to getting a loan, and for your covered period. So now this is either your 24 or 8-week covered period, whichever you select. And there still remains this 25% reduction in payroll. For many people that we were talking to, or many companies we were talking to, they didn't expect to have any reduction in actual payroll costs during the 8-week covered period. That might change now with the 24-week covered period. So again, you got to get a better understanding of how that might impact if you go with the longer covered period. It was very clear that you will only get penalized for one or the other. So in the recent SBA guidance that came out in May, they said that you will not get both hit for an FTE reduction and a salary reduction if the wage reduction was tied to FTEs. So the example provided in the guidance was an employee was working 40 hours, is now working 20 hours, but continues to get paid at the same pay rate. In this example, you would only get hit with an FTE reduction, but you would not also be penalized for salary or wage reduction because this employee remains to get paid at the same pay rate. So FTE reductions, again, this is based upon your covered period, 24 weeks, or you can elect 8 weeks if your loan was originated prior to June 5th. And so the 2 look back periods is February 15th to June 30th of 2019, period a year ago, and or January 1 to February 29th, 2020, right before the pandemic forced a lot of companies to close. Under recent guidance, it became very clear that FTE calculation is based upon a 40-hour FTE. Again, if you're using this alternate covered period, you would calculate it for that period, not the original covered period. In the guidance, no employee can be counted more than 1 FTE. So those employees that were working more than 40 hours, you limit them to a 1 FTE. And for those employees working less than 40 hours, you can base it upon 2 methods, either the actual, nearest 10th, or just count everyone at a half FTE if they're working less than 40 hours. And so we're suggesting you try both calculations to see which one maybe works the best for you. So here's the example. In this example, during their covered period, which is either 8 weeks or 24 weeks, their full-time equivalents are 60. Last year, they were at 62 for that February 15th to June 30th. And right before the pandemic, they were at 73. So in this example, they get to choose the lower of the two, so they compare 62 to 60, and they get charged with a 2 FTE multiplier reduction FTEs, which we'll show you shortly. Now, there are some safe harbors. And so the safe harbors are, if you rehire employees, if you use an 8-week period by June 30th, and if you use a 24-month period, you now have till December 31st. And if you rehire those employees and you get back to your original FTEs by rehiring these employees, this FTE reduction no longer is required. Now, there are exemptions that if you make a written offer or try to rehire employees and reject, you just got to document that, and that still counts as though you rehired that employee. These offers need to be made at the same pay rates and number of hours. And those employees that decide not to come back, you must notify the state unemployment office. There is a new provision in the law, in this new law, the Flexibility Act, that allows employers to document the inability to return to the same levels of business activity that they were incurring prior to February 15th, because they're required to file compliance and requirements, a standard by the or guidance issued by the Department of Health and Human Services, the Center for Disease Control, or Occupational Safety and Health Administration between March 1 and December 31st, 2020. So what they're getting at, an example here is restaurants, who right now are limited to only being able to accept 50% of what they originally had seating for. So right there, that's limiting their ability to bring back FTEs. And so all they got to do is document this, and they will not get penalized for that. So the compensation reduction, we believe that if you're following an 8-week period, it's probably not going to have an impact. It might on a 24-week period. And so we've done the calculation here for a 24-week period. So any significant reduction in compensation as compared to what that employee was making prior to the pandemic, which is the first quarter, that difference reduction beyond the 25% is a penalty. And so in this example, it's a 33% reduction. The amount beyond the 25% is 8%. And so that results in a reduction of your forgiveness of $2,885. So here is the calculation. In this example, the company got loan proceeds of $700,000. In this example, they have payroll costs that we just went through at $525 and non-payroll $175. So they meet the requirements at the cost level to get full forgiveness. However, they have a 2-employee FTE reduction. That's comparing the 62 to the 60, which results in a 3% penalty. So 3% of $700,000 is a $22,000. And then there's also the compensation reduction that we previously talked about of $2,885, resulting in a loan forgiveness of $674. And the remaining amount of the loan that's not forgiven is $25,465. And in this example, we're assuming that they got their loan after June 5th, and so they get 5 years to repay back the loan. Other items to note, again, if you had an economic injury disaster loan early on in the pandemic, that's not eligible and has to be added into your forgiveness. The big change here is that it defers under the new law payments of penalties, interest, and fees until the date on which the amount of the forgiveness is determined and remitted to the lender. Under the old law, this was 6 months. Now it just leaves it open-ended until you get your forgiveness. So you will not have to pay any principal, interest, or fees until you know what your final loan is. Again, additional guidance might be forthcoming. We expect a substantial amount, yet definitely a new application. And again, all final loan forgiveness will be the final determination of SBA. We believe on loans at $2 million, you're going to go to your bank and apply, and the bank's going to look at your supporting documentation and submit to SBA, and it will be more streamlined. If it's over $2 million, there might be additional work required. Real quick on the IRS positions, it was clear in the CARES Act that the PPP loan forgiveness would not be taxable income. This was not addressed in the Flexibility Act, so they have not addressed this yet. The IRS ruled on April 30th, 2020, that they agreed that the income is not taxable, but they went on to say that any expenses paid for through forgivable PPP loans are not tax deductible. So basically removing the tax deduction. That still is in place. The application, file with the bank. You'll need documentation for any costs you're claiming. I don't believe the documentation is going to change. You can find the required documentation on page 10 of the existing application. The bank has 60 days to review your forgiveness application and accept it, and then send it to the SBA. And then the SBA has up to 90 days to remit the amount of forgiveness back to the bank. You must retain documents for this forgiveness application for 6 years. We're expecting an updated application. The original application, and this is how the SBA did this, had an expiration date of October 31st, 2020. So in theory, you had to file under the old 8-week period by October 31st. We also expect that to change. The other big change here is that there's this payroll tax delay. And previously, you were not allowed to participate in this program if you had received a PPP loan. And basically, this would allow you to defer paying any of your employer's matching FICA for the remainder of the year and pay it back over 2021 and 2022 for the next 2 years. Okay, and the Flexibility Act now says you can use this program. So if you're got a PPP borrower, you can now defer paying these taxes to increase the cash flow within your company or your organization. And again, most companies, it started in basically at the beginning of the second quarter, and you have not filed your payroll tax return yet, so you can still apply for this. I would work with your payroll departments, or if you're using a payroll processing company, to get this set up as soon as possible. But this will allow you to defer these payments if you would like. It's our understanding there's no interest on the repayment, and you get 2 years to repay the amount of the deferred taxes. So again, another nice benefit of the program. Again, real quick, economic injury disaster loans are still out there. For those organizations that are still struggling with cash flow, you can apply for these. We're recommending that you wait for the end of your PPP loan forgiveness. So if you're using 8-week, you can do that soon. If you're doing a 24-week, you got to be real careful, because items funded by this program cannot be used for forgiveness under your PPP program. And so these loans typically do fund payroll also. So you guys got to make sure all states qualify as an economic injury disaster area. And so you can apply for these loans in every state through the SBA. Again, it's a loan. It's not forgivable. It is not forgivable. You must pay this back. It works under the original determination of a small business. So the 500 employee rule does not apply here. You must meet the original SBA loan size requirements for your industry to qualify for this. You fill out the application and then negotiate a loan and repayment terms with the SBA once approved. These loans are usually at 4% interest, and you have up to 30 years to repay them. So it is a nice way to get some additional cash flow and not have to pay it back real quick. Also, as part of this, if you do qualify this, you automatically get an economic injury disaster loan grant of $10,000. However, that will be taken off the amount forgiven for your PPP loan. So again, here's how you apply. Here's all the websites. So again, real quick, decide to do a Paycheck Protection Program or then the economic injury disaster loans. Again, the big difference is the terms. 30 years on economic injury disasters, 2 to 5 on the PPP. And there still is employee retention credit, but if you're participating in the Paycheck Protection Program, you cannot participate in the employee retention credit program. And then finally, before we go to questions, I want to leave about 15 minutes here for questions. Just want to give a quick update on changes in the state of Ohio. The workers' comp has agreed to do another 3 months of deferral of worker comp premiums. So they're deferring June, July, and August payments do not need to be made in those months and will be deferred in the future. They also provided a $1.6 billion dividend already to employers, which was a 100% return of your 2018 premiums. And then lastly, if you get beyond the PPP program and you start still having issues of getting back to work and stuff like that, there is a shared work Ohio voluntary layoff aversion program you can participate in. And again, by doing this, you agree to keep all your employees, but reduce their hours. And the hours that are reduced are picked up as unemployment benefits through the state of Ohio. So, time for questions. Greg Taylor has been monitoring the questions. So as we go through this presentation, so I'm going to turn it over to Greg right now to see what we have out there and see if we can answer them. Greg?
Yeah, thanks, Bob. So I think there was quite a few questions. Could you just walk through again of the covered period, the 8 versus 24, and what if I don't need the full 24 weeks? What can I do there? Can I turn my application in? So could you just kind of walk through that again? I think there was multiple questions regarding that.
Yeah, I don't think there's an ability to do anything other than 8 or 24. So there's no ability to do, let's say that you are at 16 weeks and you've met your requirements. I don't believe there's any ability to submit an application for a 16-week cover period. It's very clear in the law that the cover period is defined as either 8 or 24 weeks. And we don't see any ability right now to do it for a different period. There might be guidance coming. And again, if that's something that companies are concerned about, we recommend pushing back to your congressmen, your senators, the SBAs, raising these questions. They do listen and they have been responding quite well to the concerns. But right now we believe it's only 8 or 24 weeks.
And Bob, can you clarify to have that option when that loan and how you determine when that covered period starts? Because that was another question related to that.
The cover period, no matter when you select 8 or 24 weeks, starts for the day you got your funding. The original origination of the loan, the day the money was put into your bank account. That's the starting period, whether you use an 8-week or 24-week, it starts then. For payroll costs, there is that alternate payroll period we spoke about. You can choose for your payroll cost, just to line it up with your payroll payment cycle. You could do that, but it officially starts the day your loan originates. Greg, was there a second part to that question?
The second part was the June 5th, right? Where if you got the proceeds before June 5th, you have to use the 8 weeks.
Yeah, so it's clear in the law that, and it's from guidance recently provided by SBA, that loans made after June 5th cannot use. They have to use a 24-week cover period. Those that were originated prior to June 5th can revert back to the existing rules and use an 8-week cover period.
Bob, there was a question regarding the actual financial reporting of these loans. The forgiveness piece, the actual loan itself. Did you want to make a comment on that? I know there's
there's 2 concepts. There's 3 concepts I think you got to think about. Generally accepted accounting principles, how this is going to report it on your financial statements, and then tax reporting. And again, I'm going to defer to tax reporting until we get very clarification on how the IRS will deem whether or not when you have to report this as income, but it's really not going to be taxable income, but disallowing those expenses. So again, I got to believe the IRS is going to rule that, if you're not going to get those expenses, if you file your tax return and you find out that you use forgiven loan proceeds to cover those costs. My gut tells me the IRS says you're not going to be able to deduct those on your 2020 tax return, but time will tell on that one. For generally accepted accounting principles, there's two methodologies out there. The SEC has ruled they will accept either. We are waiting to hear from the AICPA and FASB to see which, if they're going to make a final determination for smaller companies. So there is one methodology that we've seen before in old existing grant programs. You know, for-profits have been getting grants before, like this, forgivable loans. They're not been a lot, but they've been happening in the past. And we've seen this in some real estate transactions. And so in theory, the way those have worked is that you start recognizing the income as you incur the cost to have a matching principle. As long as you have a reasonable basis to believe you're going to get that forgiveness. There is this concept of a cliff that you record the cost and you do not record the forgiveness until you get the final approval, and then you would get a lump sum forgiveness in that period you got the final approval. Again, the SEC has ruled they'll accept either. You know, so you know it depends. You know, we'll wait to hear what the AICPA says. I would think for most companies dealing with either a bank or a bonding company, if you're allowed to start taking that income into your income statement and subsidize losses that you might have, will be very beneficial in calculating covenants at the end of the year and stuff like that. So again, we just got to wait for a final ruling and to see which direction we end up going with this.
Bob, the next question is a nonprofit organization with approximately 35% of the payroll is funded by state, local, and federal grants. So what grant restriction language can we refer to how to treat the payroll costs for grant-funded employees? Is there any specific prohibited, you know, double dipping? So
yeah, so they made a decision on this. You can't double dip. So if the payroll is already being covered by a grant and you're claiming it under another federal grant program, you cannot also claim forgiveness for those same payroll costs under the PPP program. So you cannot double dip. So what we're been working with the not-for-profits is first, you know, projecting out all their compensation and coming up with how much is being covered by other grants and the remaining amount what's available for the PPP loan forgiveness. Now you can maybe negotiate with your granting agency to see if you can defer payments on those payroll dollars and use the PPP first and then use their grant dollars down the road. But that would have to be negotiated with your grant provider.
Bob, the next two questions kind of go back to, again, the 8-week or the 24-week period. So if the 8-week, you need to use June 30th as your date for full restoration. Yep.
Yep, for the FTE. I'm sorry, Greg. I'm sorry. Go ahead.
No, yeah, for the full restoration. That was the question.
Yeah. So it's still June 30th date.
Yep. And so the same type of thing, if you're using the 24-week, is the December 31st, is that the deadline? If say you hit above your target during that 24 weeks, but at December 31st, you dip back. That's the same example you used in the construction. You do have to look at that because you would be penalized. Is that correct?
That's correct. That's correct.
This is a quick question. Disability insurance paid for employee qualify as payroll costs?
I don't believe so.
I agree with that.
It's not health insurance. The only insurance that qualifies is health related.
You know, this question is regarding like the alternate pay period where there's a stipulation of has a bi-monthly or monthly payroll rather than bi-weekly, that they cannot use the alternate pay period. Is that correct?
I don't believe that's correct. I think they can start using whatever pay period commences after they got the origination of the loan. It was never defined to be a weekly payroll period. The example is a weekly, but it was never designed for that. It's you start for the first payroll, no matter what cycle you're on, for the first payroll that commences after you got the PPP loan dollars in your bank account.
Do you, next question, do you have to use the full 24 weeks? What if you need only 10 weeks? Can you turn your forgiveness paperwork in at that time that you've kind of met the requirements?
No, because you still have to do the FTE testing and the payroll reduction testing for 24 weeks.
Exactly. If we, that question was already answered, because if someone's let go for, say, retirement or fired for cause, does that hurt your FTE situation when you're doing the final count?
No, you get credit for those people.
Just trying to sort through the ones we've answered that one. If you have two loans for two different companies, can you claim one period, one in the 8-week covered period versus the 24 for the other?
Well, you got to select a period. So again, so
Well,
each company selects their period. So the company selects 8 weeks, then they file the loan payments for that company during 8 weeks. If the other company selects 24 weeks, then you follow the 24 weeks for that company.
Each company is independent themselves.
Yeah, that's correct. Each is a separate loan.
Yep.
Each is a separate.
Next question. Our last 8-week payroll is 7/3, which does not include June 30th. Can FT be based off the payroll date of 7/3, or is it the manpower we have on June 30th?
No. So for FTEs or for counting the payroll costs. So for counting the payroll costs, you would probably want to select an alternate payroll period if you need to include that payroll in there, and you could. For FTEs, it's through June 30th.
Does life insurance count towards payroll costs?
No, only health insurance.
And again, it's another question that's come up. Like, so if you're staying with the 8 weeks, it's June 30th is the period, not December 31st.
That's correct.
Yeah. If you apply for an EDI grant only, and you don't want, can you apply for a grant only and not need the loan?
I believe so. I believe so. I think it's automatic. I believe you can just keep the grant and decline to take the loan.
When do you have to make the election on the 8 versus 24?
When you file your application.
And is there a stipulation on what time the application needs to be for, like if you're going to select the 8-week covered period?
Yes, yeah, so I believe it's 60 days after you're in your 8-week covered period.
I agree with that.
Yep.
Can you use the alternate payroll period if you are a semi-monthly employer?
Yes.
Yeah. Is a line of credit secured by all assets, especially inventory and AR? Is this the interest considered eligible for PP forgiveness?
That's a gray area.
Yeah.
I think it might, but it's gray area. It's not very clear.
Leased vehicles.
Yes.
Are those allowed?
Yes. As long as the lease is in the company's name, that company should be the borrower of the PPP loans.
I think we've answered that question. Some needs to come in since we've. Go down one more. Sorry, there's quite a few questions that come in since the last.
Yeah, sure. We got about 2 minutes left for 11 o'clock, but we can still stay on for those that want to stay on and hear the answers.
Or what we'll do is we'll make sure we will send an answer to everybody to their questions.
Yeah, that's correct.
And make sure their response.
But there's any other ones we can handle right now in a minute or two. Is there anything, Greg, that we haven't already answered, or maybe it's something you need?
So just a clarification, you can only elect alternate if bi-weekly or weekly or less frequent.
I think you can whatever your normal payroll cycle is, you can follow the alternate payroll period.
Yeah, we'll have to look at that, Bob, because I'm not sure about the twice a month.
Yeah, okay.
If not, the bi-monthly might not be covered. We'll get back to that.
We'll get back to that, but I'm not.
Everybody.
I'm pretty sure, and if not, we can probably request guidance from the SBA, and I'm sure it would be. It was not the intention to limit it. It was to make it easier to align with your payroll, regardless of that payroll cycle.
like you said, since it's 11 o'clock, there's quite a few more questions, but we'll respond directly to everybody on those to get the responses. We appreciate if there's more questions too, feel free to email us at info@GJM, please. And we will get these answers back to everybody.
Yeah, well, thank you everyone for attending. We had a good turnout.
Bob, it's Susan. I'm going to chime back in real quick just to say thank you for your expertise, and Greg as well. And thank you everyone for attending. I also just want to mention real quick, we will plan on posting the recording of the webinar if you'd like to go back and check something on our website, gjmltd.com, in our COVID-19 Resource Center, which is gjmltd.com/COVID-19 resources. So with that, we'd like to thank you all again for coming and hope you have a great day.
Take care, everyone. Bye-bye.